Here is the property evaluation according to the 4 pillars. This is what the input looks like. We have a description. I'll pull up the Excel and show you that here in a minute. You have the purchase price, whatever the estimated rents are, whatever the down payment is, the insurance, estimated repairs, the amount of money that you expect to hold for reserves, and like all the blue that you can fill in. The estimated closing cost is calculated, and the property management, repairs, maintenance, those are all calculated. Utilities is also fill in, and HOA and other expenses that you're expecting. These are the assumptions. We assume for this that management is at 10%. If you're doing your own management, then that would be at 0. Property tax rate, we assume, I generally use the assumption here in California, or at least in Sacramento area, 1.25%. I'm assuming an annual growth rate of 3%. Obviously, markets fluctuate. During the last downturn, Sacramento went through a drop of 68%, which is huge. 2005 was our previous peak. It took all the way until 2020 before we went up. So over decades, there is always appreciation and growth. Houses cost more than they did in previous decades, but sometimes there's marked up and down in a marketplace. So be aware of what to expect for appreciation in the market over time. Maintenance estimate, that's just a percentage of whatever your rents are that you're likely going to have to spend maintaining the property, and closing costs, what your cost at your original purchase. And loan terms, well, interest rates typically for non-owner occupied properties are about 0.5% over whatever the conventional loan rate is. Right now, the loan rate's at about 6.5%, so I put 7% here, and the loan terms at 30 years. Now, with these property numbers, the basic numbers, and the assumptions, then we come up with some calculations at the end. So here's the results that it spits out the end, and we'll go through a couple of properties here with you before we close. Money needed, that's whatever amount is the down payment plus closing costs, repairs, plus your reserves. The returns, which is your monthly cash flow, it's the gross rents less the loan and less your loan, PITI, and less other expenses that you have. There's the annual returns, which we calculated 3 different things. We add all those together. What's your cash flow, which is the amount of cash flow. This is shown in months. That is what's your cash flow every month. This is shown annually. So what's your appreciation? That's assuming, once again, a 3% appreciation. And what's your loan pay down? That is for your loan, given the terms of the loan, how much are you getting in equity on the loan during the first year? And then what's your annual returns on this property? Lastly, we calculate return on investment, ROI, which is simply the relationship between your annual returns and the money that you put out, both the down payment, cost of repairs, and the money you're holding in reserve. So that's money that you're not spending in other places. So that's your return on investment. And that's a little bit different from what many other people consider to be return on investment. A lot of times they just figure it's a down payment and closing costs. They don't count in reserves into it, and they're usually looking at the return on investment with just cash flow. So cap rates are calculated that way, and usually it's cash on cash return. How much money did you put in, how much money you're getting back. Appreciation and loan pay down are some of the best investments for residential properties. It's those 3 that make it really powerful.
Debt reduction and principal reduction on the mortgages are consistent. Those you can calculate. You can't calculate appreciation or depreciation because that's a market issue.